Hello traders, Steve Ganz here, and I've got a new trade that I'm putting on today. Now, in disclosure, I personally put this trade on live. I've mentioned it numerous times that it is a butterfly. In this case, it's a broken wing butterfly, which is one of my favorite trades when I can put it on correctly at a good price. This trade, I normally put this thing on out anywhere from 60 to 90 days, somewhere in that general vicinity. This one is the September 20th expiration. I am urging anyone to consider a trade like this to make it in paper. I'm going to share the link to this trade, but this is a broken wing butterfly. Now, normally this trade cost me about $2.10 to put on. This is a 60-50 broken wing butterfly in the SPX. So there's 60 points in down range here and 50 points in up range. This trade carries a fair amount of risk. Now, this can be done in a one lot, and then rather than 10,000 in risk, it would have 1,000 in risk. But the couple things that are important to note in this is I have a nice wide range of my tent, 55.40 down to 54.40, so 100-point wide range in my tent. Nice thing to have, but you'll notice, and people have brought this up before, the chance of profit is only 13%. Well, how can that be? Well, chance of profit is what is the possible profitability, the likelihood that this will be at a profit at expiration. In other words, will it be in this tent at expiration? Well, that expiration is so far out in the future, it's kind of hard to tell. I mean, SPX could be anywhere at that point. But the key to a butterfly is knowing and understanding how to adjust it as the market moves forward. And when I say forward, when the market moves forward in time. Now, if this market were to go up, the nice thing about this butterfly, because in this case, this trade is normally $2.10. Again, on this one, because the volatility was up today, and when volatility is up, you can get more money for your puts that are close to the current price of the market. That makes this overall trade less expensive, gives you a better reward to risk ratio in the trade. The nice thing about this, if our market does rip back up, yes, if I never adjusted this trade, I could lose a little bit to the upside. I could lose $300 if the market went up to 10,000. That amount would be the same. Now, I will adjust this trade. If our market moves up, I will adjust this trade to basically make sure that I have zero risk to the upside on this trade. If the market were to rip to the downside, there are adjustments I can make. I do, of course, have a little more downside risk in this trade, but that downside is further away, but I of course would have to adjust if the market were to sell off as well. Now, one of the things I wanted to look at here, let's come in and look at a chart of SPX, and I'll kind of show you why I considered this specific trade. Let me go to a daily chart here. So why I considered this trade specifically, as we can see, SPX has stayed essentially in this channel now for months. So it's run very tightly in the channel. Right now we are at the bottom of the channel, maybe just a hair outside the bottom of the channel. I don't let that little bit outside the channel freak me out too much. Also, if I were to draw a line across here, this would have been support because we had a high here. Then when we broke through that high. We tried breaking through there, didn't. Tried breaking through here, did break through. So that former resistance will oftentimes become support. So there's a couple things here telling me that we may, I stress may, bounce up from here, or maybe even just trade sideways a little bit from here. In both of those scenarios, I'm perfectly fine with this, because if we trade sideways, what will happen is as days tick off, as a little time goes by, this trade is going to get some profitability in it. Also, if volatility drops right here at 14%, volatility is up a little bit compared to what it has been recently. if I take a little volatility off this trade, we can see that profitability comes in rather quickly as well. So this is really a trade that's looking at a couple different things. One, that I feel I'm at a support level where the market's likely to go up. I have very limited upside risk in this particular trade, $300 in upside risk right now. But again, if the market does in fact shoot up there, I'll be able to adjust that. If the market stays about where it is, sort of chop sideways for a few days, I will have some decay happening in the trade. If volatility reduces in this trade, I will have profitability in this trade. If the market tanks hard and volatility increases, that's kind of the worst scenario for this trade. That would definitely put a ding in this trade. But even then, even if the market were to sell off, let's say from 5,500 down to 5,300, that's a massive, massive move. And while I'm certainly down in this trade, I'm not down a huge amount. And when volatility spikes up further, this trade becomes easier to adjust to the downside. And I know people make comments down below and they ask about upside adjustments, downside adjustments. Unfortunately, the answer to that one is there's probably about 6 or 7 common downside adjustments. There's probably about 4 or 5 common upside adjustments. But there's a lot of variability into when you might use each one of those. It depends how long have I been in the trade at the time that that big move occurs. What is my expectation on market movement after a big move occurs? Am I expecting after a big sell-off the market to bounce back? If that's the case, I might make one adjustment. If my case is, I think we might be going lower from here, I have to make a little bit different adjustment. So unfortunately, it's not a real simple answer as to exactly how I would adjust it. All that said, I do plan on making this trade, continuing this trade live as part of the, live trade series, if you will, the start to finish live trade series. So you will get to see how I handle this going forward. One other quick note, you'll see that the profitability in this trade bounces all over. Keep in mind, SPX is a large vehicle, number one. Number two, I've got on a 10 lot. So when there's variance in the bid-ask spread, when the bid-ask spread widens out a little bit, this trade can show a big loss or a big gain if that variability tightens up in my favor. And the reason there's that variance is, again, this thing's 30 days out. There's not a lot of people trading it yet. And I'll also tell you one final little tidbit. I've shopped this trade now for 3 days. I've had this trade, the order out there waiting to get a fill. So it's not like I just go out and pay up whatever price I need to pay up to and get in this trade. Because it's so far out, I shop it. I place an order out there. I let it set for a while. I will tell you that I have my actual fill prices entered here. That's why this little dollar sign shows up. That means that I personally edited and put in these specific prices. The combination of all of this added up to me essentially paying 30 cents to get into this trade. And again, normally this trade, if volatility is back down around that 10% range or so, I could easily pay $2.10 to get into this trade. So I know that was long, but I know I've shared a lot on butterflies, and I think it's important to try to give as much information as I can. If you find this content of value, again, please like, subscribe, give me a thumbs up, and I look forward to following this trade through with you going forward. Take care, everyone.